Friends, we will spend about 45 minutes strictly on this particular aspect of taxation, that is non-resident taxation. Of course, here the number of points that you need to make a note, we strictly say that it should not be more than 15. Let us see how many points you are going to jottle down. Why I am saying like this is, most of the provisions which we are discussing here are all the one which you have already read, or other way around, the one which already I explained in the earlier sessions when you studied the TDS or when you studied the capital gains and all. But definitely this taxation of non-residents, I personally feel, is a very important from the CA final examination point of view, because in order to revert the Supreme Court judgment in the Vodafone case, several amendments are being made at different parts of the income tax law. So the whole session's idea is to tell you how the amendments are being brought in the different areas of taxation. So for that purpose, Vodafone case earlier also we have discussed. What is it? There are two companies, Hudson International, and what has happened is Hudson International has got a subsidiary company, 100% subsidiary company in the Mauritius Islands. Now there is an Indian company, Hudson SR. Hudson International is holding 67% in Hudson SR Limited, which is an Indian company, and 33% is held by the SR. Now this Hudson International also got a subsidiary company in Mauritius, and it is basically an investment company. So that Mauritius company, along with its own subsidiaries, is now investing in the, what is it, HEL, Hudson SR India. So how you have to remember this particular story? Hudson International is there. Now Hudson SR Limited is there in India. Hudson International is having 100% holding in a company in the Mauritius, and that company along with its subsidiaries is holding in Hudson SR 67%, and SR is holding 33% in Hudson SR of India. Now what has happened is, Hudson International Limited made sale of its investment in the company which is there in the Mauritius. To whom? Vodafone. Consequently, Hudson International is getting capital gains, and Vodafone is purchasing these shares of the Mauritius company from Hudson International. So who is the payee? Who is the payer? Payer is the Vodafone and payee is the Hudson International. Now what they thought is, these two companies, Hudson International and Vodafone, are the non-resident companies, and what is getting transferred is the shares of the company which is located in the Mauritius. So what they felt is, this transaction will not have any implication under the Indian income tax law. But our income tax department says what? Although you say you are making a sale of the shares of the company which is located in the Mauritius, but that Mauritius company is the investor in a company which is located in India, and by purchasing that Mauritius company, now Vodafone is able to exercise the controlling interest in this particular Indian company. So naturally the transaction of purchase of the shares of Mauritius company indirectly, since it is enabling the Vodafone to have the controlling interest in the Indian company, the capital gains arising to Hudson will be taxable in India, and Vodafone being the payer to the Hudson International need to deduct the tax at source. Since it has not done, what is it? The Vodafone International is a SSE deemed to be in default. Of course, they have gone to the Supreme Court level and they won their case, but the finance minister brought amendments in the income tax law, and that too also with a retrospective effect. Consequently, what happened? That is, at many places you need to make the amendments, like your asset definition of 2 clause 14, transfer definition of 2 clause 47. So many places the amendments are being brought. That is the whole story. And now let me also read the story, and without your feeling that why sir is reading this story again even after explaining, because ultimately these two exams at least 10 to 12 marks will be based on these amendments. So you need to have a clarity over that. So section 9 deals with what? Income deemed to accrue or arise in India. Provides a set of circumstances in which income accruing or arising directly or indirectly to the non-resident is taxable in India. One of the limbs of the clause 1 says, is the income accruing or arising directly or indirectly through transfer of a capital asset situated in India. So any income arising to a non-resident by transfer of a capital asset which is located in India, such a income shall be deemed to accrue or arise in India. So in the case of Vodafone International Holdings, Supreme Court held that transfer of shares of a foreign company, a special purpose vehicle which holds underlying assets in India by a non-resident to another non-resident would not be liable to the tax in India. The decision also underlines the doctrine that the suits of shares is where the company is incorporated, where its shares can be transferred, and where the register of members is maintained, and not the place where underlying economic interest of such shares lies. This is how Supreme Court says. So in order to overcome that Supreme Court ruling, the amendment is proposed with a retrospective effect from 1962 to 63 to clarify that legislative intent of section 9(1) is to widen the application as it covers incomes which are accruing or arising directly or indirectly. So it has been explained that section 9 codifies the source rule of taxation. So section 9 is basically based on source rule. Now where the actual economic nexus of the income is situated has a right to tax the income irrespective of the place of residence of the entity deriving the income. So it is not the place of residence of the entity, it is the place of source of that particular income that you have to take into consideration. So it has been further explained where the corporate structure is created to root the funds. The actual gain or income arises only in consequence of investment made in the activity to which such gains are attributable, and not the mode through which such gains are realized. And internationally also this is a practiced principle. So in the memorandum explaining the finance bill, what is stated, it is proposed to provide a validation of demands. So once that validation of demands come, even if at a later date if a reversal happens, there is no obligation for the department to make the refund of the taxes that they have paid. Validation of the demands raised under the Income Tax Act, and in respect of the income accruing or arising through or from transfer of a capital asset situated in India. So in consequence of the transfer of the share or shares of a company registered or incorporated outside India, or in consequence of an agreement or otherwise outside India. So now it is proposed to provide through the validation clause that any notice sent purporting to have been sent taxes levied, demanded or assessed or imposed or collected or recovered during any period prior to coming into force of the validation clause shall be deemed to have been validly made, and such notice or levy of tax shall not be called in a question on the ground that tax was not chargeable. Any ground including that it is a tax on capital gains arising out of the transactions which have taken place outside India. So they have brought this validation clause to safeguard tomorrow a possibility of refund coming. They said there is no question of refunding this particular amount of the tax. So validation clause shall operate notwithstanding anything contained in any judgment, decree or order or of any court or tribunal or any authority. So this validation shall take effect from the time when this Finance Act of 2012 comes into force. So the whole idea of this particular amendment is like, even validation clause is, even in case tomorrow somebody challenges in a court of law regarding the constitutional validity of these amendments, then also whatever the taxes that are paid earlier, again department need not refund back. That is the whole idea behind it. So now we are trying to understand the taxation provisions with respect to the non-residents. What we say, some of the sections dealing with the taxation of the non-residents have been amended with retrospective effect, and these amendments will have a far-reaching effects. While presenting the budget, the finance minister has not made any mention about these far-reaching changes affecting the non-residents, but in the explanatory memorandum attached to the finance bill, the reasons for the retrospective amendments have been explained. What is the effects of these amendments? First is the effect of these amendments with retrospective effect will be that the cases of many SCs may be again be reopened and they may be required to pay the tax, interest and penalty for last 16 years. So it appears that these amendments will provide taxing gain on sale of shares in foreign countries. It is not going to stop with Vodafone, but many other companies are also going to get affected, and this being a retrospective amendment. And more paining thing is not only that the government can get the tax, but they can also get the penalties and the interest also. So it is necessary that a specific provision should have been made that no interest or penalty will be payable if tax is levied as a result of the retrospective amendment. Earlier also what is stated, section 28 and 80 HHC were amended by the taxation laws, but in a circular they have issued, they have directed the tax authorities that don't levy the penalty and interest if the tax levied is due to the retrospective amendment. But a similar kind of thing is not being now done, so we are waiting for such kind of circular. So the circular also provided that the tax due as a result of the retrospective amendment can be paid in 5 equal installments. No interest was payable on such a installment. Let us hope that CBDT will come with a similar circular as a point. Now of course those which already you have written, I am not asking you to write again, but since we are discussing the non-resident taxation, all the provisions relating to this non-resident taxation, let us have a revision part of it. Earlier also we have studied the definition of a capital asset given in section 2 clause 14 as a point. So what is section 2 clause 14? It defines a capital asset. What is a capital asset? Capital asset is a property of any kind. So this section defines that the term capital asset means property of any kind held by an assessee, whether or not connected with his business or a profession. So however, assets in the nature of stock in trade, personal effects, agricultural land, these are all being excluded from this particular definition. Now explanation has been added with effect from 1/4/1962 to clarify that property shall include and shall deem to have always included any rights in relation to an Indian company, including the right of management or control or any other rights. This will mean that the term capital asset shall now include tangible as well as intangible property. Then I move to the next section which got amended is section 2 clause 47. This also we have studied when we studied the capital gains topic. Section 2 clause 47 discuss about the transfer. So transfer in relation to a capital asset. This is an inclusive definition and it includes transfer of a capital asset by way of a sale, exchange, or relinquishment or extinguishment of a rights in the asset and compulsory acquisition of the asset. Now the new explanation is added even to the your 2 clause 47 also, which says that transfer shall include and shall be deemed to have always been included disposing or parting of an asset or any interest therein or creating any interest in any asset directly or indirectly, absolutely or conditionally, voluntarily or involuntarily. Such a transfer may be by an agreement made in India or outside India. So this is irrespective of the fact that such transfer has been characterized as being effected dependent upon or following from the transfer of shares of an Indian company or a foreign company. So this will show that if any interest is created in the shares of an Indian company or a foreign company by an agreement, even an action, it will be considered as a transfer. So all this is being brought only to say reverse the Supreme Court judgment in the Vodafone case. Now section 9 also is being amended. Of course, the 3 explanations which are being made to this, already you have made note of it. Just have a again once more revision listening. This section explains when income is deemed to accrue or arise in India in case of a non-resident. So the scope of this section got widened with explanation 4 and 5, and that also with a retrospective effect from 1/4/1962. So in section 9(1), it is stated that any income shall be deemed to accrue or arise in India directly or indirectly through or from any business connection in India or any property in India, any asset or source of income in India, or the transfer of a capital asset which is situated in India. Actually, our case falls into the D part. So now it is clarified through explanation 4 that the word through in the above section shall mean and include by means of or in consequence of or by reason of. So this explanation appears to have been introduced with a retrospective effect to counter the decision of Supreme Court in the Vodafone case. So similarly, you have got explanation 5 which clarifies with retrospective effect from 1/4/1962 that asset or a capital asset being any shares or interest in a foreign company shall be deemed to be situated in India if such shares or interest derives directly or indirectly its value substantially from the assets which are located in India. So it may be noted that the concept of holding interest in the substantial value of the assets located in India has not been explained or defined in this explanation. So the concept is explained in various other sections of the income tax law. Now when we talk about substantial interest, what is substantial interest, friends? That is, person having substantial interest in the company is stated that if a person holds 20% or more of the share or carrying that is shares carrying 20% or more of the voting power, then that person is said to have the substantial interest in that particular company. Section 40(a)(2) deals with what? That is the provisions of transfer pricing are now made applicable even for the domestic transactions. In the definition of related party, again you have got the concept of the substantial interest. And in section 79, what is stated? For carrying forward of the losses of a closely held company, what we say, that is the right to carry forward comes only when shareholders holding a share capital giving 50% of the voting power continues to be the shareholders even in the year in which they want to set off the loss. So, in view of the above, for determination of the tax liability on transfer of the shares in a foreign company, the concept of holding substantial interest in the value of the assets which are located in India should have been clearly defined, but that has not happened. Further, the section refers to the share on interest in a foreign company which derives its value substantially from the assets located in India. The word value is also required to be defined. So, once I start looking in depth into it, I can make any amount of criticism, and I can also make the people to understand what are all the areas of loopholes again through which you can still continue your argument. Then friends, I move to the definition of royalty, which also we have discussed in the topic of the capital gains in detail. Here we are running for the simple reason, since already these sections are well explained there, we are only trying to make a revision. Royalty, what we are saying, section 9(1) provides that any income payable by way of a royalty in respect of any right, property or information is deemed to be accruing or arising in India. And again the term royalty has been defined in explanation 2, which means consideration received or receivable for transfer of all or any rights in respect of a certain rights, property or information. Actually, this has made us to say that in case if you are paying for any software, earlier whatever that I have paid for software, that and all used to be an intangible asset on which I used to claim 60% of the depreciation. Now with this amendments, that royalty, that whatever I am paying for acquiring that particular right to use the software, now it also comes under the royalty, and that is allowed as a revenue expenditure, section 37. But only thing is you have to deduct the tax at source, failing of which you don't get the deduction. So some of the judicial decisions have interpreted this definition in the context of taxability of shrink wrapped off-shelf software sale of software and licensed software, wherein they found distinction between use of copyright and use of a copyrighted article, and held that use of copyrighted article is not a royalty. So these are the decisions. I am not reading all those citations. The courts have also analyzed whether right, property or information has to be used directly by the payer or is to be located in India, or control or possession of it has to be with the payer, and it has been held that payment for use of a transponder capacity for uplinking or downlinking data would not constitute royalty income. Ultimately our interest is to overcome all these decisions, and what we said, the amendment is made in order to overcome the above limitations. This amendment is proposed with a retrospective effect from 1/6/1976 to restate legislative intent. So that is most important. What is it? What is the intent of that particular provision? That you have to see, not the legal frame of it. So however, the above amendment of the Income Tax Act may not nullify the provisions of the DTAA signed by the India. So this section provides that income by way of a royalty earned by a non-resident is deemed to be the income accruing or arising in India under the circumstances explained in the section. That means the user must use the same for the business carried on in India. So new explanation 4 is now added to provide that transfer of any rights in respect of any right, property or information includes all or any rights for use of a right to use the computer software, irrespective of the medium through which such right is transferred. Again, one more new explanation 5 now provides that royalty includes consideration in respect of any right or property or information, whether or not the possession or the control of such right is with the payer, such a right etc. is used directly by the payer, the location of such a right etc. is in India. This is how this is being explained with an example that the banking companies in India are using the servers of the foreign banking companies in order to help their clients. So naturally whatever the Indian banks are paying to the foreign servers, although server is located outside India, service is rendered outside India, we still say the income will be deemed to accrue or arise in India. So that also that payment is being now taken the form of the royalty. You have to deduct the tax at source. And a new explanation 6 provides that expression process used in the section includes transmission by satellite, including uplinking and amplification, conversion for downlinking of any signal, cable, optical fiber, or by any other similar technology. So this is irrespective of the fact whether such process is a secret process or otherwise. It appears that the provision has been made to overrule the decision of the Delhi High Court in Asia Satellite Telecommunications is a point. So some of the points which are related to the above amendments, if I look at the above amendments with retrospective effect from 1/6/1976 will create a lot of practical difficulties. What are the practical difficulties? It is now possible that the tax department may consider part of the purchase consideration for software paid to a non-resident as a royalty payment, and the amendment read with amendments in section 195 with retrospective effect from 1/4/1962 will create a greater hardship for the taxpayers, as it will be impossible to comply with the TDS provisions in respect of such payments. Already I have made the payment to the person from whom I purchased this. Now if I say, no, my Indian government has brought a beautiful provision, now I have to deduct the tax at source, kindly give that money so that I will pay the tax and give you the certificate. By now, probably that company from whom you purchased this particular software might already got liquidated. Then where do these Indian SSEs will go? So it is also possible that a SING officer may invoke the provisions of section 40A, thereby disallowing that. So again, what will happen? That is, if the assessments are in the process with respect to those years, their incomes can be enhanced and heavy taxes will come. So it may, however, be noted that if any such payment is made to a non-resident in a country with which there is a DTAA, the provisions of DTAA, if favorable, will apply in preference to the above provisions. And again, you have section 90 and 90A. What is section 90 and 90A? See, only if that is not being discussed earlier and if that point is not being written by you, kindly make note. Other way around, it is only just listening so that your knowledge which you have obtained in the capital gains topic, I am only revising that, and whatever you have listened in the TDS topic, only that you are again making a revision here. Section 90 and 90A, central government is empowered to enter into double taxation avoidance agreements with the different countries and have adopted agreements between specified associations for relief of double taxation. This scheme of interplay of the treaty and domestic legislation ensures that the taxpayer who is a resident of one contracting country to the treaty is entitled to claim the applicability of beneficial provisions. See, what is that we have studied in double taxation avoidance agreements chapter. In case if those provisions of DTAA are more beneficial, the SC can adopt those provisions, and there your income tax provisions will have no application. It has been explained that in many instances the taxpayers who are not tax residents of contracting country do claim the benefit of DTAA entered into by the government with that country. Thereby even a third party residents claim unintended treaty benefits. Therefore, it is proposed to amend section 90 and 90A to make a submission of TRC as a necessary for availing the benefits of the agreement referred to in these sections. So this is in line with circular number 789, which is issued by the CBDT with reference to the India Mauritius DTAA and Supreme Court decision in case of Union of India and others versus Azadi Bachao Andolan, which has been confirmed the validity of the said circular. So however, it has been explained that memorandum explaining the finance bill that it is not sufficient condition for availing the benefit under DTAA. So the memorandum tends to hint the assessing officer can go beyond the TRC and verify whether the taxpayer is a tax resident of that country applying the substance theory. So basically our intention is in DTAA, double taxation avoidance agreements, we wanted to give the benefit to what is it our country and the citizens. So a third party cannot take the benefit of the DTAA is what all this discussion. So what is it? Section 90 empowers the central government to enter into agreements with any foreign country or specified territory for double taxation avoidance taxation relief. Section 90A empowers the government to enter into similar agreement with certain specified notified associations or specified territories. Both these sections are amended as under. So now what is your new section says? Of course, this you have to make note. First try to understand what your new section says. New section 92A is inserted with effect from 1/4/2013 to provide that, what is it? Section 95 to section 102. What is it? General anti-avoidance rules. Anyhow, we are also going to take up the discussion on GAAR also, will be applicable even if the provisions of DTAA are more beneficial or favorable to the SC. In other words, where GAAR, that is a general anti-avoidance rule, is invoked, the SC cannot seek the protection of the beneficial provisions of the DTAA. Similar amendment is also made in section 90A also. So first make a note of this understanding of us. So far we are living with one concept. What is that concept? Once a particular transaction is getting covered by the double taxation avoidance agreement, the SSE can take very well the benefit of the provisions contained in the double taxation avoidance agreement. But now we have brought a beautiful concept called as general anti-avoidance rules. In case if general anti-avoidance rule is invoked in a particular SSE's case, then such a SSE cannot take the benefit of the, what is it, DTAA is the point. Please make note. Section 90 subsection 2A where GAAR means what? General anti-avoidance rules is invoked. The SSE cannot seek the protection of the beneficial provisions of DTAA, cannot seek the beneficial provisions of DTAA double taxation avoidance agreements. Then friends, have a look at another new section of 90 subsection 4 is inserted to provide what? Non-resident cannot claim the benefit of DTAA unless a certificate in the form prescribed by the CBDT is obtained from the foreign country with which Indian government has entered into the DTAA. कैसा certificate? वो वहाँ है बोल के. Just on paper it is a created entity, or is it in operations? नहीं तो यहीं बैठ के वहां एक एंटिटी खोल सकते ताकि हम we can avoid the taxes. So year after year what I am looking at is, it is not that the government don't want to give a benefit to anybody, but all efforts are being made to see that the benefit really goes to the intended persons to whom that benefit should reach. People cannot artificially create a situation whereby they try to take the benefits which are given with a different intent. So the point here is, if you want to claim a benefit of DTAA, take a certificate from the other country. So please make note of section 90 subsection 4. Non-resident cannot claim the benefit. Non-resident cannot claim the benefit of DTAA unless a certificate in the form prescribed by the CBDT. A certificate in the form prescribed by the CBDT is obtained from the foreign country, with which the Indian government has entered into the DTAA. So what will be there in that certificate, friends? Please make note. In this certificate, such a foreign country will have to certify. In this certificate, such foreign country will have to certify the place of residence, of the non-resident, and such other particulars as may be required to decide whether benefit claimed under particular DTAA is available to non-resident. Then friends, a new explanation 3 is inserted to section 90, which says what? That is, with effect from 1/10/2009 to provide any meaning assigned through a notification under section 93 to a term used in DTAA shall have effect from the date of coming into force of the applicable DTAA. So this is only a clarificatory kind of thing, not much of a relevant from the examination point of view. Now I move to the section 195. Here also I don't expect the students to write anything because all these provisions are being well discussed when we discuss the TDS provisions. But to tell you as a revision, section 195 deals with the deduction in respect of the payments made to the non-resident other than 194 LC and other sections, which also covers the payments to the non-residents. So this section provides for deduction of tax at source in case of payments made to non-residents. This section is now amended with retrospective effect from 1/4/1962. By this amendment, it is provided a new explanation 2 that the obligation to comply with the TDS provisions will apply with the retrospective effect to all persons, whether they are residents or non-residents. Again, in saying whether they are residents or non-residents, because Vodafone is a non-resident. One non-resident is paying to another non-resident. Normally till today what is our understanding? Section 195 and its application is once resident makes the payment to a non-resident. Now we say 195 is equally applicable to the one non-resident paying to the another non-resident also, as long as that income is liable for a tax in India. Even if the payer happens to be a non-resident, still TDS provisions will have an application. So far section 195 was understood to put the obligation of TDS on residents and non-residents who have got a permanent establishment in India and who make payment to the non-resident of income taxable under the Income Tax Act. So now with effect from 1/4/1962, the obligation is extended to the non-resident persons who has a residence or a place of business or a business connection in India any other presence in any manner whatsoever in India. So it may be noted that the obligation for deducting the TDS is never made under chapter 17 of the Income Tax Act with the retrospective effect. So all these provisions for the TDS whenever introduced or amended are from prospective dates to enable the payer to comply with the same. Even in the Finance Act of 2012, such provisions for TDS or amendments are made in section 193, 194E, 194J, 194LA, 194LC and 195(7) only with the effect from 179 2012, but surprisingly only with respect to 195 what we say it is being done with a retrospective effect. Generally the amendments relating to the non-residents will be prospectively working but not retrospectively, but surprisingly with respect to section 195 they said no, it is to be done retrospectively. So however explanation 2 has been inserted in section 195 with the retrospective effect from 1/4/1962. By putting such obligation to deduct the tax on certain non-residents who are not covered by this section earlier will create definitely practical difficulties. It may not be possible to deduct the tax from payments covered under section 195 for the earlier years, and they may be saddled with a huge interest liabilities and other penal consequences. See, why this kind of drama will be done generally is, at least by that we can get the TDS. See, if I say with Vaishnavi that I will give 10 slabs, probably Vaishnavi say, sir please stop with 5 slabs. If I say I will give you a slab, then she will start arguing with me that why, what made you to slap me. But once if I say 10 slabs, she will be continuously thinking that how to bring that to 10 to 5, right? So now we have brought all these amendments, thereby the power is there now with the income tax department. It can ask the non-resident, it can ask the SSEs to pay the tax, interest and penalty. Then with so much of the recommendations and lobbyings, then the government will say, okay, we will give a circular whereby interest and penalty can be avoided. Then the representatives of those SSEs will go out and say, with all our great effort, government we were able to convince that interest and penalties could be avoided. This is a drama, but we have to live with it. So take one small point so that to that extent the discussion we can close it off. Section 195, that is, it is provided in the new explanation 2. It is provided in new explanation 2 that obligation to comply with the TDS, obligation to comply with the TDS provisions will apply with retrospective effects, to all persons whether residents or non-residents as long as such a non-resident is having a residence or place of business residence or place of business, or business connection in India, or are any other presence in any manner whatsoever in India. Then friends, I move to the new section of section 195(7), which is inserted with effect from 1/7/2012. This amendment, what it says, CBDT may by notification specify a class or class of persons or a cases where a person responsible for paying to a non-resident any sum whether chargeable to tax or not can make an application to the assessing officer to determine the appropriate portion of sum chargeable to a tax. On such a determination, tax will be deductible under section 195(1) on that portion of the amount. Such a determination by the AO may be by a general order applicable to all similar payments, or may be a specific order applicable to one specific transaction. So, already we have discussed this particular point. In order to avoid the litigation, whenever the non-resident gets any doubt, he can make an application, and Central Board of Direct Taxes is being given, what is it, a power to specify what is the tax amount and how much of the portion of that will be brought into the tax net and all that. So, please make note of it. Section 195(7). Section 195(7). CBDT may by notification specify class of persons or cases where the person responsible for paying to a non-resident comma any sum whether chargeable to tax or not, they have to make application with whom? Assessing officer, not with CBDT. Can make an application to the assessing officer, to determine the appropriate portion of the sum chargeable to tax, Then of course, assessing officer can either pass a general order or a specific order applicable to that specific transaction. Then friends, I move to section 163. What is our section 163? Treating a person as an agent of non-residents.